Welcome back to the deep dive. Today we are moving way past the headlines and plunging directly into the high-stakes corporate surgery that's happening right now within the global chemical industry.
Yeah, and we're focusing on a giant.
A true giant. We are dissecting one of the world's largest, LyondellBasell, or as you'll see it on the ticker, LYB.
And this is a necessary deep dive because, look, LYB isn't just navigating a typical downturn. It is executing a radical, multi-billion-dollar strategic pivot right in the middle of a perfect storm.
A perfect storm. That's the perfect way to put it.
I mean, we're looking at a company that is fundamentally trying to change its very identity. It's moving from this, sprawling, diversified conglomerate.
Right, with refining and all sorts of other pieces.
Exactly, to a highly focused polymer and derivatives leader.
And the environment they're doing this in is just brutal. I mean, we know this because their own CEO went on the record describing the current climate as the longest and deepest downturn of my career.
When a CEO says that, you listen.
You absolutely listen. And that quote is really the starting point for our entire analysis. So our mission today is to synthesize this massive transformation. We want to understand the structural economic forces that are driving this crisis, to analyze the advantages that LYB is now doubling down on, and critically, to scrutinize the highly aggressive financial tightrope they are walking right now. They're trying to survive the present, to even have a chance to build that future.
And the central conflict here, for you, the listener, is this fundamental shift in vision. LYB's historical earnings were driven entirely by the volatility of commodity cycles.
Right. Buy low, sell high.
Basically, buy cheap hydrocarbons, sell expensive polymers. But their new strategy, it attempts to engineer a predictable, high-margin future, one that's powered largely by, proprietary technology and these new circular solutions.
So they're trying to move from being a price taker to a value creator.
That is the goal. But they have to survive the most acute financial pressure the company has faced in, I would say, over a decade to get there.
Okay, so let's unpack that context first. Before this major strategic overhaul, as you said, LYB was known as a diversified chemical and refining conglomerate. Now, that's all shifting.
Shifting fast.
The focus is narrowing aggressively onto their core polymer and derivatives business. So why the intense focus now, and what exactly is the core business model that makes it so prone to these, devastating cyclical troughs?
Well, we could break the core business down pretty simply. LYB is a leading global manufacturer of chemicals and polymers, but it's fundamentally a highly capital-intensive business.
Meaning you have to spend billions just to play the game.
Billions. Massive fixed investments in what they call crackers and production facilities. And because of that structure, profitability isn't really about innovation in, the way Silicon Valley thinks about it. It's about managing the spread.
The spread. That's the make or break metric in the petrochemical world. It really dictates everything, doesn't it?
It absolutely does. Everything. The spread is simply the difference between your input cost and your output price.
Wow.
Specifically, it's the cost of hydrocarbon feedstocks. So think things like natural gas liquids, NGLs like ethane, or oil derivatives like naphtha versus the global market price of your finished outputs.
Which are things like polyethylene and polypropylene, the plastics we see every day.
Exactly. And when the global market gets saturated, that output price is basically fixed by whoever the cheapest marginal producer is.
And the spread gets crushed.
It compresses violently. And at that point, competition just collapses into pure cost management. That defines the famously cyclical nature of this whole sector.
And we are currently in a trough that is, according to the CEO, worse than anything the management team has ever seen. What are the elements that came together to create this so-called perfect storm that just wiped out profitability?
You've got three major elements hitting all at the same time. First, there's persistent overcapacity, which we'll definitely get into that.
Okay.
Second, you've got weak global demand. This is driven by, post-pandemic inflation, stagnation in key durable goods sectors like construction, European industrial activity just falling off a cliff.
And the third piece.
The third piece is these looming, massive, capital-demanding sustainability pressures. All of this has combined to compress profitability to the, quote, lowest margin levels in over a decade.
Wow.
We are seeing utilization rates for foundational chemicals like ethylene just hovering around 80% globally.
And 80% sounds high, but in this industry, that's terrible. Right?
It's a disaster. Those are levels we haven't seen for a full decade, and it means there's an enormous amount of idle capacity just sitting there, which keeps pricing power at basically zero.
But we can't just blame weak demand for this. You mentioned overcapacity, and the sources all point to a structural driver that makes this feel like more than just a typical down cycle.
Oh, it is.
And that driver seems to be the explosion of new supply capacity, particularly from China.
That is exactly where the structural reality of this crisis lies. If this were just a demand problem, it would eventually fix itself, inventories would clear, but we have a fundamental imbalance in supply that is going to persist for years.
So what are the numbers?
Look at the figures. Between 2020 and 2025, global ethylene capacity expanded by over 40 million tons.
40 million tons.
It's a massive addition. But over that same period, global demand only managed to grow by an estimated 27 million tons. That gap, that 13 million ton gap, is persistent structural oversupply. And it has to go somewhere.
And when we look at where that new capacity came from, the picture is, it's pretty striking.
It is. The nugget that really changes the game is that an estimated 70% of that new capacity was built and commissioned in China.
70%.
And this wasn't accidental growth. This was a deliberate, state-backed industrial policy. It was designed for self-sufficiency. For years, the global chemical industry relied on China as the world's largest importer of many key chemical chains.
Right. China was the customer for everyone.
It was the crucial destination for Western and Middle Eastern production. That whole paradigm has just been shattered.
So China has stopped importing, or at least cut back dramatically, and is now aggressively flooding the market with its own product.
That's it exactly. China has fundamentally shifted from being the world's largest importer of polymers and derivatives to becoming a net exporter in many of these key chemical chains, particularly things like polyethylene and PVC.
And the ramifications of that.
I mean, think about it. Every single producer globally who relied on selling their product into China now has to find a new home for that volume. And they're often undercutting prices just to compete with this new, cheaper Chinese supply.
It's margin destruction on a global scale.
It is. It's not a cyclical blip. This is a permanent change in the competitive landscape. And it forces high-cost producers to rationalize, which is a nice way of saying they have to shut down capacity across places like Europe and Northeast Asia. And that brings us directly to LYB's pivot.
Okay, so that structural reality, China becoming the new global marginal supplier, it makes LYB's massive pivot feel, I don't know, not just strategic, but almost mandatory.
Oh, completely mandatory. There was no choice.
They just can't afford to carry these volatile, low-margin assets in uncompetitive regions anymore. So the first dramatic step was the exit from refining. Let's talk about the magnitude of that decision to just stop operations at the Houston refinery.
The cessation of operations at the Houston refinery, which is scheduled for February 2025, was a truly defining moment in the company's trajectory. You really cannot understate the scale of this move.
What kind of revenue are we talking about?
That single asset contributed $8.1 billion, or 21.7% of the company's total 2024 revenue.
Wow. 21% of revenue.
This wasn't a minor tweak. This was like spinning off a piece of the company the size of an entire mid-cap S&P 500 company.
So $8.1 billion in revenue, gone. That's why management classified it as a discontinued operation. They are structurally exiting a volatile, capital-intensive, and frankly, low-margin legacy business that often had its own profitability cycles.
Right. Cycles that were completely independent of the core chemical business. It just muddied the waters. This move clears the decks.
It absolutely clears the decks. But the move that speaks even more directly to the structural crisis we just discussed is their second major move, divesting their disadvantaged European exposure, the O&P EAI segment.
That's the one.
Their European footprint was significant. It was nearly 20% of their 2024 revenue. So why were these assets deemed structurally vulnerable? Was it just high labor costs, or was it entirely about the inputs?
It was overwhelmingly about the inputs. LYB's European facilities were, simply put, operating on the wrong side of the feedstock divide.
The feedstock divide. Okay, explain that.
They primarily rely on naphtha as their feedstock. Naphtha is derived from crude oil, and so its price tracks global oil benchmarks, which are fundamentally more volatile and, critically, more expensive than the natural gas liquids available in the U.S. Gulf Coast.
So maybe back when Russian gas was cheap, Europe could compete. But in the current geopolitical and energy climate, they are just fundamentally uncompetitive against the U.S. and the Middle East.
Precisely. They are structurally handicapped by their energy costs and their input volatility. And that reality forced the company's hand. In June of 2025, they formalized the agreement to sell 4 major European O&P assets, spanning France, Germany, the UK, and Spain, to the private equity firm Akeida.
So they found a buyer.
They did. And this is a critical move expected to close in the first half of 2026. It's a necessary surgical removal of their most costly, least competitive assets on a global scale.
And this all hinges on that feedstock divide, which, for LYB, means they're consolidating all their effort onto the U.S. Gulf Coast. This is their undisputed moat, correct?
It is the single most durable competitive advantage they possess. Their core earnings engine, the O&P Americas segment, is concentrated right on the U.S. Gulf Coast. That gives them access to cheap, abundant ethane.
Which comes from the shale gas boom.
Exactly.
Yeah.
Ethane is an NGL, a byproduct of the massive North American shale gas boom. And this input cost advantage is structural, it's durable, and it's highly resilient.
So, in a compressed margin environment where competition is entirely price-based, the U.S. producer who can crack that ethane is basically guaranteed to be on the lowest part of the cost curve globally.
That's it.
Meanwhile, the European or Asian producer who's using naphtha, which is linked to global crude oil prices, is forced into this continuous rationalization and shutting down plants.
That is the dynamic in a nutshell. When the spread between global crude oil, which drives the naphtha cost, and domestic U.S. natural gas, drives the ethane cost, widens. The U.S. Gulf Coast operations effectively print cash.
And LYB is just embracing that advantage now, doubling down on it and exiting the high-cost regions where they just can't control that input price risk.
That's the pivot.
But they also have a second mode, which seems like the complete opposite of the high-capital, commodity-focused O&P segment, and that's their proprietary technology segment. Tell us why this segment is so strategically important.
This technology segment is the perfect counter-cyclical hedge. It's a high-margin, capital-light business. They don't make stuff. They license their proprietary petrochemical and polymer production processes to others worldwide.
So they make money without having to build the multi-billion-dollar facilities themselves.
Exactly. It's a revenue stream built on pure intellectual property.
What's the flagship technology we should know about?
The primary example is the Spheripol polypropylene process. This isn't just a standard manufacturing method. It's a specific, highly optimized process.
Okay.
And the company's sales pitch, and the reason licensees are willing to pay top dollar, is that Spheripol offers the lowest operating costs and best-in-class operability.
And in an industry this capital-intensive, that's a huge deal.
It's massive. Cutting operating costs by even a fraction of a percent over decades translates into billions saved for the licensee. It also allows for the direct production of these unique polymer spheres right in the reactor, providing product advantages.
So for LYB, it's reliable, high-margin earnings that are much less volatile than the commodity markets.
Yes. This segment is a jewel in the crown that provides critical diversification and stability.
So the pivot is clear. Cut the legacy risk, consolidate the geographical cost advantage in the U.S., and rely on that proprietary technology mode. But like we said earlier, survival is not a growth story.
No, it's not.
They need a credible narrative to draw in capital. And that's where the 3 pillars of their sharpening our focus strategy come into play.
Right. These pillars are the roadmap to the higher margin future that management is promising everyone. First, grow and upgrade the core.
Which is?
That's just reinvesting in their advantaged U.S. Gulf Coast assets, like expanding propylene production. This is sort of defensive and opportunistic at the same time.
Okay, pillar 2.
Pillar 2 is step up performance and culture. That's all the internal cost and efficiency measures, including that big $1.1 billion cash improvement plan.
And then there's the third pillar. This is the one that promises the biggest structural change and really the new identity for the company. Build a profitable, circular, and low-carbon solutions, CLCS, business. This is management basically manufacturing a new growth story to escape that historical commodity trap, isn't it?
It absolutely is, and they've tied concrete, highly visible financial stakes to this vision. They're aiming for at least $1 billion in incremental EBITDA by 2030, generated specifically from this CLCS business.
$1 billion, that is a massive target.
It's huge. And considering the volatility they are exiting, the refining business, the disadvantaged European assets, they are explicitly signaling that CLCS is meant to be the structural replacement for that lost earnings potential, but at a much higher, less cyclical margin profile.
Okay, $1 billion in 7 years sounds fantastic, but let's bring in some critical friction here. They just wrote down $1.2 billion in assets in a single quarter because the commodity cycle went bad.
Right.
Now they're promising $1 billion in incremental EBITDA from a business that is essentially still nascent. Is this a credible growth engine, or is this corporate management trying to, paper over current losses with decade-long green aspirations?
That is the right critical question to ask. And the answer really lies in the execution and the specific technology they're deploying. To prove credibility, they've set hard volume targets.
Which are what?
They plan to produce and market 2 million metric tons annually of recycled and renewable-based polymers by 2030. That's 2 MMT plus WAR.
Okay, a hard volume target.
And they are already showing some early traction. They reported 65% year-over-year volume growth in 2024. Now, that growth rate is high because the base is small, but it demonstrates commitment and some early market acceptance.
How are they actually delivering this, though? I mean, you can't reach that kind of volume target just by collecting old plastic bottles. It requires serious proprietary technology and market differentiation.
It requires advanced technology, which they're branding under the Circulen family. And this branding is important because it clearly delineates the source material, which really matters to their downstream customer.
So what are the different brands?
You have Circulen Recover, which uses mechanical recycling. You have Circulen Renew, that uses non-fossil bio-based feedstocks. But the most interesting and technologically challenging segment is Circulen Revive.
And that's advanced or chemical recycling?
That's the one.
Let's zoom in on advanced recycling. This is the difference between, simply melting down a rigid plastic bottle and actually breaking down complex, contaminated waste into its original molecular components, right?
Precisely. That is the holy grail for increasing the amount of plastic that can be effectively recycled. And they are moving into industrial scale with their proprietary MoReTec technology.
RTEC.
It's a catalytic advanced recycling process. They're building their first industrial scale plant using this in Wesseling, Germany right now. And MoReTec is crucial because it can handle hard-to-recycle mixed or contaminated plastic waste that mechanical recycling just rejects. It dramatically broadens the feedstock they can actually use.
And they didn't just stop at internal R&D. They brought in a key acquisition to expand their technological depth.
That's where the strategic depth of this pivot becomes really evident. In August of 2024, they acquired the German firm APK AG.
And what did they bring to the table?
They bought them specifically for their proprietary new cycling solvent-based technology. Now, why solvent-based? Because this technology is exceptionally good at tackling flexible, plastic waste-think multi-layer films and pouches.
The stuff that's notoriously difficult to recycle.
Exactly. The stuff that's very difficult to handle mechanically or even catalytically in a cost-effective way.
So, if I'm understanding this, they've created a two-pronged technology approach for plastic waste. They have MoReTec for the chemical breakdown of mixed and contaminated waste, and they have new cycling for efficiently separating and dissolving flexible films.
That's it.
This allows them to approach the entire spectrum of waste plastics, not just the easy-to-recycle stuff.
That is the strategic takeaway. They are building a proprietary portfolio that addresses the hardest challenges in the circular economy, and they're linking specific technology, catalytic and solvent-based, to a hard financial target. This is what makes that $1 billion EBITDA target credible. It's built on specialized, high-margin IP, not just on selling generic recycled plastic. This CLCS pillar is the absolute linchpin of their long-term equity story.
The long-term vision is compelling, I get it. But we have to return to the present day, which is this brutal cyclical trough. When we look at the financials from the third quarter of 2025, the picture is just chaotic. The headline loss was massive. It suggests real distress.
Yeah, Q3 2025 was what analysts often call the kitchen sink quarter. Management used the cover of the deep cycle to just clean house. The headline was a massive GAAP net loss of $890 million.
$890 million.
A number like that would usually signal a complete disaster for a company of this scale.
But as is often the case with these big strategic moves, the GAAP loss was almost entirely an accounting event, right? Not a cash event.
Correct. The loss was driven by $1.2 billion in pre-tax, non-cash asset write-downs. These were strategic charges, impairments concentrated primarily in that O&P-EAI segment.
The European assets they're selling.
The very same ones, and also the Advanced Polymer Solutions segment, which reflects the prolonged weakness in key markets like the global auto industry. Management was essentially just recognizing that the book value of these assets was permanently diminished by the structural factors we talked about earlier.
So they were strategically taking all the historical pain in one go. If we strip away the non-cash accounting charges, what does the underlying financial health actually look like?
Excluding those one-time strategic write-downs, the adjusted performance was surprisingly resilient. Adjusted EPS for the quarter was a positive $1.01 per share.
Okay, so they were profitable on an adjusted basis.
Right, and this distinction is vital. The underlying business is still generating cash. even if the accounting book value of their legacy assets has been impaired.
And that cash generation is the most critical signal of resilience. Tell us about the divergence between that gap loss and the actual cash flow.
This positive divergence is the #1 sign of underlying stability. Despite the $890 million JAP net loss, cash from operating activities, or OCF, it rebounded strongly in Q3 2025 to $983 million.
Almost $1 billion in operating cash flow.
Right, and this proves that the core asset base, the advantaged U.S. Gulf Coast operations and that high-margin technology segment, is resilient enough to weather the trough. Cash flow is the patient's lifeblood, and it's still pumping.
So to protect that cash flow and their overall financial stability, management initiated an aggressive defensive measure they call the Cash Improvement Plan. This is financial triage. What is the scope of this plan?
The plan is comprehensive and immediate. The total target is to generate $1.1 billion in cumulative cash improvements by the end of 2026.
And where is that money coming from?
It's being squeezed out of every possible corner of the enterprise. For 2025, the sources included specific targets: $200 million in fixed cost reductions, $200 million from working capital improvements, so tightening inventory and receivables, and another $200 million from sharp cuts to capital expenditures.
Okay, so they're essentially sacrificing future growth to fund the present crisis. And we see this most clearly in their CapEx cuts and project deferrals.
Exactly. They have revised their capital expenditures, their investment in the future, down sharply to $1.7 billion for 2025. And they're targeting a further reduction to just $1.2 billion in 2026.
Wow.
And crucially, they deferred the construction of their Flex 2 growth project, which was designed to expand capacity. This just signals maximum financial discipline. When you're facing a crisis, you stop expanding and you start conserving.
And this conservation effort seems to be centered on one sacred cow: the dividend. Management is fighting tooth and nail to defend their streak of 14 consecutive years of dividend growth.
They are.
So let's inject some critical friction here. The annual cost of that dividend is about $1.8 billion. We just saw that OCF at the trough is barely covering that annual cost. Given the extreme financial pressure, why is defending this $1.8 billion dividend more important than, say, accelerating the Flex 2 growth project or just increasing their cash buffer?
That is the central strategic trade-off the board is facing. And it really reveals their perception of investor psychology. That $1.8 billion dividend is consuming virtually all available operating cash flow at the bottom of the cycle.
All of it.
But management believes that cutting the dividend would signal fundamental distress to the market, that the crisis is structural and permanent, not cyclical and temporary.
It's a psychological commitment, then, a signal to the long-term cyclical value investor.
Precisely. Maintaining the dividend signals confidence that they will recover, and it provides a premium yield for investors to wait through the trough. They are prioritizing shareholder loyalty and market signaling over immediate capital flexibility.
And we can see the consequence of that choice.
It's stark. Look at their share repurchase activity. Historically, they were aggressive buyers. They've bought back 46.5% of outstanding shares since 2013.
And now?
But buybacks have been effectively halted since Q3 2025. Every single dollar is being routed toward defending that $1.8 billion commitment and preserving the balance sheet's immediate integrity.
This prioritization of the dividend means the margin for error on the balance sheet is, well, it's razor thin. And the trailing 12-month, or TTM, debt-to-EBITDA ratio is the perfect metric to illustrate the acute pressure the company is under right now.
The leverage is, frankly, alarming. The TTM debt-to-EBITDA currently stands at 4.47x.
4.47.
That number tells the entire story of the cyclical crisis because their EBITDA has just collapsed due to the compressed margins.
And the risk here isn't just that it's a high number, it's that this number is pressing directly against the legal ceiling of their borrowing agreements.
It is. Due to the rapid deterioration of earnings, management had to go back to their lenders and amend their credit facility covenants. They were forced to raise the allowable net debt to EBITDA limit from the standard 3.5x, which is a healthy level up, to a much looser 4.5x.
And that's a temporary reprieve.
It's specifically granted through 2027 to allow them to survive this trough.
Okay, let's pause on that. They are at 4.47x, and the new relaxed ceiling is 4.5x. That means they are operating within 3 basis points of breaching their covenant ceiling.
It's less than 0.1% of margin.
What kind of event could push them over that line? It doesn't sound like it would take much.
The margin is terrifyingly small. A breach doesn't require a global catastrophe. It just requires a minor operational stumble combined with persistent low margins. Imagine an unexpected, non-scheduled maintenance shutdown at one of their major Gulf Coast crackers that takes capacity offline for a week longer than expected, or a sudden, sharp spike in domestic natural gas prices, which feeds their ethane cost that they haven't adequately hedged. Any of those things could cause a marginal, unexpected reduction in EBITDA, pushing that 4.47x ratio past the 4.5x limit.
And the implication of breaching that covenant is, it's catastrophic, isn't it?
Absolutely. The 10-K filing warns that a failure to comply with debt covenants could lead to a technical default, which would allow creditors to accelerate the debt repayment schedule.
Meaning they could call the loans immediately.
And if that happens, the company would be required to immediately repay debt that it may not have the liquidity to cover. This is the definition of acute, immediate financial risk.
And compounding all this is the threat of a credit rating downgrade. Management described preserving the investment grade rating as the foundation and priority. For the listener, why is this rating a matter of corporate life or death?
The investment grade rating is effectively a company's financial lifeline. It allows them to borrow money cheaply through commercial paper and investment grade bonds. A downgrade to junk status or non-investment grade would materially increase their borrowing costs across the entire capital structure.
And it locks them out of certain markets?
It does. More importantly, it triggers mandatory restrictions by certain institutional investors who can only hold investment-grade debt. It could dry up their access to capital right when they need it most.
And the consequence of that downgrade would almost certainly force the abandonment of their sacred cow?
It would. A downgrade would force an immediate dividend cut. Bondholders and ratings agencies, they prioritize debt reduction and cash preservation over shareholder returns. So that $1.1 billion cash improvement plan is not just about self-help. It's a high-stakes performance for S&P and Moody's.
They're trying to prove they can survive.
To prove that management can generate enough discretionary cash flow to survive the trough without breaching their leverage constraints.
And the rating agencies are circling. What are they specifically concerned about?
Both S&P and Moody's revised their outlook to negative in 2025. S&P explicitly cited forecasts of materially negative discretionary cash flow in 2025.
So they're worried about the cash burn.
They are openly questioning whether LYB can maintain liquidity while paying its CapEx obligations and the dividend. The agencies want to see proof that the divestitures, the refining and Europe assets, and that $1.1 billion cash plan will stabilize the balance sheet before the end of 2026. This rating threat is the most acute and immediate risk to the stock's equity story.
Okay, so when you look at the current financial snapshot, the gap loss, the 4.47x leverage, the nonstop uncertainty traditional valuation metrics are just, they're useless. You can't value a company on bottom of the cycle earnings.
You absolutely cannot. The trailing 12-month EV to EBITDA multiple is completely distorted. It's at 67.6x because the earnings denominator, the EBITDA, is so depressed.
That's meaningless.
Completely. Any credible investment thesis for LYB has to ignore the present figures and instead focus on normalized mid-cycle earning power. The investment is a pure, high-conviction bet on reversion to the mean.
But management is trying to argue that the new mid-cycle should be structurally better than the historical mid-cycle. How are they justifying a higher profit trajectory for the post-pivot company?
They're making a very specific argument that's based on this corporate surgery. Historically, their average mid-cycle EBITDA margin was around 18%. Their new target is a mid-cycle EBITDA margin above 21%.
Okay, so a 3-point improvement.
Right, and that 300 basis point improvement is justified by the strategic pivot. They're exiting low-margin, high-volatility segments like refining and the structurally disadvantaged commodity assets in Europe. The pro forma company will be entirely concentrated in the highest margin segments.
U.S.-advantaged feedstocks and proprietary technology.
Exactly, with the new high-growth, high-margin CLCS division contributing as well.
So let's put that vision into quantitative terms. If we assume the market eventually believes that target, what does the normalized value start to look like?
Well, we can run a simple illustrative valuation calculation. Take their 2024 revenue, subtract the $8.1 billion from the refining exit, which leaves you with about $32.2 billion in pro forma core revenue.
Okay.
If we then apply management's promised normalized EBITDA margin of over 21%, that implies a normalized EBITDA of around $6.76 billion.
And what multiple do you put on that?
If you apply their historical 5-year average EV to EBITDA multiple of 7.2x, which is pretty standard for a healthy, high-quality chemical producer, the resulting implied normalized enterprise value is roughly $48.7 billion.
So $48.7 billion in potential enterprise value versus a current market cap that is significantly lower. This is the inherent tension that defines the entire investment proposition, isn't it? Deep value is present, but it's hidden by immediate financial distress.
It is the ultimate cyclical value investment. The question isn't if the value is there. The question is if the company can survive the next 3 quarters to realize that value.
Yeah.
And this leads to a highly bifurcated, very high-stakes wager.
Let's break down the bull case then. What needs to happen perfectly for an investor to realize that $48.7 billion normalized value?
The bull case requires perfect cyclical timing and flawless corporate execution. First, the global petrochemical cycle has to definitively bottom in 2025, which management has signaled it will, and the recovery has to begin in 2026-2027.
Driven by what?
Driven by supply rationalization in Asia and Europe, the very thing we talked about. Second, management has to successfully deliver on its $1.1 billion cash improvement plan and close that European divestiture on schedule in the first half of 2026.
And if all those stars align,
The investor captures a massive capital appreciation. And while they're waiting, they're collecting a significant dividend yield. It's currently over 12% as the company achieves its higher post-pivot mid-cycle margins. It transforms from a leveraged company into a growth-focused leader.
Okay, now for the flip side, the bear case, the value trap. Given that razor-thin covenant margin, what is the single biggest fear preventing the market from realizing that value today?
The bear case centers on the fear of systemic failure. The cycle is prolonged, that Chinese structural overcapacity persists and continues to just suppress margins all the way through 2026.
So the recovery doesn't come.
The recovery doesn't come. The $1.1 billion internal cash plan proves insufficient to offset the weak operating environment, and that accelerates their cash burn. The absolute worst-case scenario is that an unexpected operational hiccup or a small earnings miss causes that TTM debt to EBITDA to just tick past 4.5x.
And the result of that covenant breach.
The credit rating is downgraded. The high-yield dividend, the very thing management has been fighting to preserve, evaporates. The company is forced to enter emergency deleveraging mode, potentially involving distressed asset sales, and the equity is immediately repriced to reflect a distressed financial condition.
So the potential for catastrophic capital loss is high. It's
Yeah.
extremely high. This is why this investment is only suitable for high-risk tolerant cyclical value investors who have extremely high confidence that the balance sheet will hold through 2026. #outro.
We have certainly mapped an extraordinary journey for LyondellBasell. We watched as ruthless global feedstock economics forced a total strategic reshaping, shedding $8.1 billion in refining revenue and divesting its most disadvantaged European assets.
And we analyzed the extreme financial triage management is undertaking. I mean, sacrificing future growth by cutting capex and halting buybacks, channeling all those savings toward defending its $1.8 billion dividend, and, more critically, its investment-grade rating.
All while operating at the very maximum of its 4.5x leverage ceiling. This is corporate surgery under fire.
It really is.
So for you, the learner, watching this all play out, what are the most essential needle-moving variables you need to monitor on a quarterly basis? You should focus on 3 specific metrics. First, the feedstock spread. Keep monitoring the price differential between U.S. ethane, the NGL, and European and Asian naphtha, the oil derivative. That spread is the fundamental measure of LYB's competitive mode.
Okay, what's second?
Second, look past the GAAP net income and focus intensely on quarterly cash from operations, OCF. OCF is the only metric that proves the company can service its debt and its dividend obligations.
And third,
Third, watch the credit rating agency actions. Any further changes in outlook or any concrete threats of a downgrade from S&P or Moody's are flashing red lights. They signal an imminent dividend cut or covenant stress.
LYB is attempting to use this period of extreme weakness, the deepest downturn of the CEO's career, to fundamentally change its structure and engineer a new, higher-margin trajectory. They're chasing $1 billion in incremental EBITDA from this new circular and low-carbon solutions business.
They're trying to build the future by sacrificing the present. And the question for you, the high-stakes investor, is whether this aggressive corporate surgery can successfully create that new high-margin patient, or if the patient will bleed out financially before the new strategy can even take hold. The margin for error is, as we said, measured in basis points.
A fascinating test case in corporate survival. We'll catch you next time for the next deep dive.